Welcome to my channel. In this video, we are going to learn money market instruments, how the money market works in our country. A detailed description is given to you for your better understanding of money market. What is money market? It is a financial market. It is a trading place for short-term financial assets with a maturity period of 1 year or less. So normally less than 1 year as financial assets are being traded in the money market. It deals with highly liquid and low risk financial instruments that are traded on stock exchanges. Money market purpose is to offer short-term financing to borrowers such as private investors, governments and others. What are money market instruments? Money market instruments are financial contracts that are traded in the money market for periods of less than a year. Money market instruments are trading for the financial contracts. Normally, the period of maturity is less than 1 year. Those money market instruments are being traded in this money market place. So, money market instruments are financial contracts that are traded. Money market instruments. The institutions that offer money market institutions to the lenders, normally the investors, those people are commercial banks, corporations, government and non-banking financial institutions. So, these institutions, they offer money market instruments to common investors. So commercial banks, corporations, government, non-banking financial institutions, they offer money market instruments to the lenders, namely the investors. What are the types of money market instruments? There are 5 types of money market instruments are available and are very famous. The first one is certificate of deposit, CD. The second one is TB, it is treasury bills, commercial papers, repurchase agreements, bankers' acceptance. Hence, these 5 are very familiar money market instruments available in our markets. First, we will see what is certificate of deposit, that is CD. This is issued directly by commercial banks at a discount rate. So, the certificate of deposit is issued by commercial banks at a discounted rate. The tenure of the certificates range from 7 days to 1 year. So, hence, naturally, it should be within a year. So, the tenure is from 7 days to 1 year. Similar to bank deposit, the certificate of deposit is similar to a bank fixed deposit. Higher negotiating factor and high liquidity. So it can be negotiated and high liquidity is available. Introduced by the Reserve Bank of India in the year 1989. Investors' popular investment option for looking for short-term assets since they carry no risk while offering interest rates greater than those offered by fixed deposits. TB, the treasury bills. Treasury bills are issued by the Government of India to meet its short-term requirements. The treasury bank notes are issued at a discounted value. So treasury bills are also issued at a discounted value. Traded on our primary and secondary markets. Treasury bills are normally traded in the primary and secondary markets. The associated risk is negligible. Do not generate any interest. The profit is the difference between the maturity value of the bill and the discounted purchase price. So when you buy at a discount prices, you can sell at the maturity price. The difference is normally the price of the treasury bills. Commercial papers. Unsecured money market instrument is issued by well-established corporations as promissory notes. So commercial papers are issued as promissory notes by unsecured money market instrument issued by well-established corporations. Maturity period is less than a year. Interest rate is quite low if you compare it with other debt securities. Enables corporate borrowers to avail of short-term borrowing by raising capital directly from the market. So borrowers, when they need money, it is available for short-term borrowing. For raising capital directly from the market, commercial papers are being used. Repurchase agreements. This is also known as buybacks. Formal agreements between two parties where the issuer offers a guarantee to repurchase the security in the future. So formal agreements, two parties should be agree and for the issuance of guarantee to repurchase the security in the future. Transaction can only be made between two parties that are approved by the RBI. The Reserve Bank of India should approve the transaction between the two parties. Then only the purchase agreements can be executed. The date of purchase and interest rate is predetermined. So when do you want to purchase? The date of purchase and the interest rates are being predetermined in the case of repurchase agreements. Bankers' acceptance. The last one is bankers' acceptance, issued by commercial banks. Financial document that guarantees a future payment to the lender. It gives a guarantee for the future payment to a lender. Document clearly mentions the repayment terms, including the date of repayment and the amount to be repaid. When the amount would be repaid and what amount will be repaid are all clearly mentioned in the repayment terms. In regard to bankers' acceptance, the maturity period ranges from 30 days to 180 days. Key features. Key features of money market instruments. The money market instruments are low risk, highly liquid. Whenever you want it or will purchase it, you can readily do it. It is quite secure, issued at a discount on their face value. That is a specialty of these money market instruments. RBI regulates the money market, hence it is quite safe. Major source of funding for the government. The money market instruments are the main source for funding for the government. Meet borrowers' immediate cash flow needs. If a borrower needs immediate money, this can be achieved through these money market instruments. Are there any risks? Yes. Some risks are in the money market instruments. The limited returns. Returns are very limited. Because the maturity period is less than a year, the returns are also less. Limited options. Only these types of money market instruments are available and you cannot invest in other investing opportunities. So availability of options are limited. Risk of inflation is there. Whenever the inflation rises, the return is also affected through the risk of return. So risk of inflation affects the money market instruments, returns, profits, etc. Thank you for watching. Please like, share and subscribe. Thank you very much.